let's do some variable costing. When we're talking about variable costing, there's a couple of things we need to keep in mind. First, we need to know that variable costing uses the contribution margin income statement format. The contribution margin income statement format is our sales minus variable costs equals contribution margin. Remember, we learned about contribution margin in Chapter 5. Contribution margin minus fixed costs equals net income. So we're trying to separate our fixed and variable costs. When we do that, we need to know that it does not include fixed overhead when calculating product cost. Fixed overhead is considered a fixed cost, not a variable cost. So it is not included when calculating product cost. It is, however, reported on the income statement as a fixed cost. So the full amount of fixed overhead will be used on the income statement under variable costing. The last thing we need to know is that the income statement will be prepared using units sold for all variable and product costs. And variable costs will be calculated as units sold times variable cost per unit. Okay. Now that we have the basics, let's look at an example. We're going to look at exercise C from our textbook, which is the Dancing Diva. And they produced 115,000 units this year and sold 110,000. They've given us the total amount of the costs, and we have to calculate cost per unit under variable costing and prepare a contribution margin income statement. All right, variable costing. We have direct materials, direct labor, variable overhead. Fixed overhead is not used in variable costing product cost. It is used in the income statement, which we will see down here, but it is not used when we're calculating product cost per unit. For direct materials, they gave us direct materials of 517,500. We calculate the variable cost per unit based on units produced. And there were 115,000 units produced. So that's going to give me a direct material cost of $4.50. For direct labor, the problem said that the total direct labor amount was $1,840,000. We're going to take that again. We're dividing it by the units produced, because we want a product cost based on units produced. Same thing with variable overhead. Variable overhead is 805,000. And this is going to give me a product cost per unit of $27.50. Now, we've used units produced here to calculate the variable cost per unit. We will not use units produced in our income statement. Our income statement is always based on units sold. It says in the problem that we sold 110,000 units. So we're going to start with our sales. Here it tells us that each unit sells for $40. So to get our sales amount, we'll take the units sold times $40 each. Now we need our production cost. This can be called production cost, product cost, cost of goods sold. Any of those all mean the same thing. So we have our production cost. We're going to take, again, always using units sold on the income statement. So we have 110,000 units, and we're going to multiply it by the product cost we just calculated at $27.50. This includes all variable product costs. We have sales commissions. Sales commissions, it said, was $550,000. We can use that $550,000, or we could have calculated a cost per unit at $5 each and take the units sold times that cost. Either way, we would get the same result. So then we're going to add these together to get our total fixed costs. Under the contribution margin income statement, we take sales minus variable costs to get the contribution margin. This is the amount left over to cover our fixed expenses. So now we need our fixed costs. And they're going to give us our fixed costs here in the problem. They have given us fixed overhead. Sales commissions is variable, so that won't be, we already accounted for that. Then we have fixed selling and fixed admin. So we are using fixed overhead in variable costing, we're just not treating it as a product cost, we're treating it as a period cost. The fixed overhead was $400,000, the selling expense was $80,000, and the administrative expense was $300,000. So that gives me a net income of $45,000. If I take this total fixed costs and I subtract the contribution margin, that's how I get my net income. Next video, we'll discuss absorption costing.